Inventory represents a significant asset for many businesses. It's crucial to have a standardized way to account for this asset. This is where IAS 2 comes in. IAS 2, also known as International Accounting Standard 2, provides guidelines for accounting for inventory. It sets out the principles for recognizing, measuring, and disclosing information about inventory in the financial statements. IAS 2 is crucial because it ensures consistency and comparability in financial reporting. By adhering to IAS 2, businesses provide users of financial statements with reliable and relevant information about their inventory position. This transparency helps investors, creditors, and other stakeholders make informed decisions. They can accurately assess a company's financial health and performance. The standard impacts various aspects of a business, including financial reporting, tax, and inventory management. Understanding and correctly applying IAS 2 is essential for businesses to comply with accounting standards. It also helps them make informed decisions about their inventory. Inventory, in simple terms, refers to the goods or assets that a business holds for the purpose of sale in its ordinary course of business. This includes goods in their finished state, those in the process of production, and materials used in the production process. Different businesses have different types of inventory, depending on their industry and nature of operations. For example, a manufacturing company might have raw materials, work in progress, and finished goods as inventory. A retail company, on the other hand, would primarily have finished goods ready for sale to customers. Understanding the different categories of inventory is important because IAS 2 applies to all these types. It's also important to note what IAS 2 does not cover. It excludes certain types of inventories, such as work in progress arising under construction contracts and financial instruments held for trading. These exclusions are important to keep in mind when applying the standard. Determining the cost of inventory is a crucial aspect of IAS 2. The standard requires that inventory be measured at its cost. This cost includes all costs directly attributable to bringing the inventory to its present location and condition. These costs can be categorized into three main components. The first component is the purchase cost. This includes the price paid to acquire the inventory, as well as any import duties, transport costs, and other directly attributable costs, like insurance during transit. The second component is conversion costs. These are the costs incurred to transform raw materials into finished goods, including direct labor costs and production overheads. Finally, other costs that are directly attributable to bringing the inventory to its present location and condition are also included in the cost of inventory. This might include, for example, costs of designing products for specific customers. However, IAS 2 is clear that certain costs, such as storage costs, are not included in the cost of inventory. Instead, these costs are recognized as expenses in the period they are incurred. Once the cost of inventory is determined, IAS 2 requires that inventory be measured at the lower of cost and net realizable value, or NRV. NRV is the estimated selling price in the ordinary course of business, less the estimated costs of completion and the estimated costs necessary to make the sale. In simpler terms, it's the amount a business expects to receive from selling the inventory, less any costs associated with getting the inventory ready for sale and selling it. The lower of cost and NRV principle is a core concept of IAS 2. It ensures that inventory is not carried on the balance sheet at an amount higher than the amount it is expected to be sold for. This is a prudent approach to accounting for inventory, as it prevents overstating assets and profits. For example, if the cost of an item of inventory is $100, but its NRV is only $80, then the inventory must be written down to $80. This write-down is recognized as an expense in the income statement in the period the write-down occurs. Section 5, Inventory Valuation Methods, FIFO, WAC, and Specific Identification. IAS 2 allows businesses to choose from different methods to assign costs to inventory. The most common methods are first in, first out, or FIFO, weighted average cost, or WAC, and specific identification. Each method makes different assumptions about the flow of costs, which can lead to different outcomes in the financial statements, particularly when costs are changing. FIFO assumes that the first units purchased are the first units sold. This method reflects the actual flow of goods in most businesses. WAC, on the other hand, uses a weighted average cost to determine the value of inventory. This method is often used when inventories are similar in nature and it is difficult to track the cost of individual units. Specific identification, as the name suggests, involves tracking the actual cost of each individual item of inventory. This method is typically used for high-value items or items that are not interchangeable. The choice of inventory valuation method can significantly impact a company's financial statements, especially during periods of inflation or deflation, and can affect key financial ratios. Section 6. Recognizing inventory costs and write-down reversals. IAS 2 mandates that the cost of inventory sold be recognized as an expense in the period in which the related revenue is recognized. This is known as the matching principle, a fundamental accounting concept that seeks to match expenses with the revenues they generate. This ensures that the income statement accurately reflects the profit or loss for the period. If the selling price of inventory declines, or if there is evidence of obsolescence or damage, IAS 2 requires that the carrying amount of inventory be written down to its NRV. This write-down is recognized as an expense in the income statement. However, if the circumstances that previously caused the write-down cease to exist, IAS 2 allows for the reversal of a write-down. This means that the carrying amount of inventory can be increased up to, but not exceeding, its original cost. Section 7 IAS 2 Disclosure Requirements. IAS 2 requires companies to disclose significant information about their inventory in their financial statements. This includes the accounting policies adopted in measuring inventory, including the cost formula used. Companies must also disclose the total carrying amount of inventory, categorized by its nature: raw materials, work in progress, and finished goods. Further, IAS 2 mandates the disclosure of the amount of any write-down of inventory to NRV and any reversals of such write-downs. The amount of any inventory carried at fair value, less costs to sell, also needs to be disclosed. These disclosures provide users of financial statements with valuable insights into the composition and management of a company's inventory. It helps them understand the assumptions used in valuing inventory. They can also assess the risk of inventory obsolescence or other factors that might affect the value of inventory. Section 8. Implications of IAS 2 on business practices. IAS 2 has significant implications for various business practices. By ensuring inventory is valued accurately, IAS 2 impacts a company's financial position, performance, and tax liabilities. Firstly, the choice of inventory valuation method can influence a company's reported profit, asset values, and tax liabilities. Secondly, IAS 2 promotes better inventory management. By requiring regular assessment of NRV, businesses are encouraged to actively manage their inventory levels, minimize waste, and avoid holding obsolete stock. This leads to improved operational efficiency and reduced storage costs. Thirdly, complying with IAS 2's disclosure requirements enhances transparency and comparability in financial reporting. This is crucial for investors and other stakeholders who rely on accurate financial information to make informed decisions. Section 9. Challenges and conclusion. While IAS 2 provides a comprehensive framework for inventory accounting, implementing the standard can pose challenges for businesses. One key challenge is the complexity of inventory valuation, especially when dealing with a large volume of diverse items. Determining the appropriate cost formula and applying it accurately requires careful consideration and often involves subjective judgments. Another challenge lies in estimating NRV, which can be difficult due to market fluctuations, unpredictable demand, and other external factors. Estimating the cost of completion and the costs necessary to make the sale also involves uncertainties. Despite these challenges, IAS 2 plays a vital role in ensuring the reliability and comparability of financial reporting. By providing a standardized framework for recognizing, measuring, and disclosing inventory, IAS 2 enhances transparency and helps stakeholders make informed decisions. Therefore, understanding and correctly applying IAS 2 is crucial for businesses to comply with accounting standards, optimize inventory management, and present a fair and accurate view of their financial performance.